Brad Neuman, considering where we are in the cycle, you say that active investing is better than passive investing. Certainly the stock pickers out there are due for a win because the indexes have been beating them for a while.
Yeah. Well, typically when the Fed is raising rates, the business cycle is in a more mature phase. So as a result, return dispersion increases and is driven more by company fundamentals rather than macroeconomic factors. And that's really critical for stock pickers, makes it more of a stock picker's market, and should enable active managers to outperform mindless passive indices.
And you also say that growth should beat value in 2016. Well, they've been doing it for a while, I think, right?
Yeah, it's true. Growth has been outperforming year to date, but we're confident that growth is going to outperform in the near future as well. And that's really based on the empirical data that we look at. So we went back to Fed tightening period since the early 1980s, and growth factors such as sales growth or earnings momentum have outperformed the market in those periods, while value factors like dividend yield has underperformed. And so that's probably because there's a premium put on growth, in the mature phase of a cycle, and investors are really looking for companies that can generate their own growth through market share gains within the economy rather than being simply dependent on the economy. And of course, that's good for someone like Fred Alger, which specializes in growth stocks and has been doing that for over 50 years.
All right, and you are a fan of hedged equity. There's a lot of liquid alts there now. So I guess that the low-hanging fruit when it comes to gains for the stock market is over. So you think you got to be hedged now?
Well, not necessarily. We think the economic expansion still has time left in it, but we think it's a really good environment for pure stock pickers, and hedged equity certainly takes advantage of that for a couple of reasons. It's really timely. Number one, volatility we think will increase. So volatility has proven to be cyclical over the past 25 years or so. It increases in the latter stages or in the mature phase of an economic cycle through recession and falls thereafter. Now we're 6 years into the current economic cycle, and volatility has actually been pretty low recently, so we think it's going to increase, and that's good for hedged equity because, of course, it mitigates risk due to the shorting component. The second reason we think it's timely is if you look back at Fed tightening cycles, we look back at the past three, going back to the mid-1990s, hedged equity has not only outperformed on a nominal basis against the stock market, but it has had lower risk as well. So if you look at something like a risk-adjusted return, like a Sharpe ratio, it's been double that of the stock market over those three periods.
All right, so you like growth, you like stock pickers, you like hedged equity. One more question about what investors should do in 2016. What should they do with their bonds?
Well, we're primarily an equity shop, but one interesting thing that investors might want to consider is to take advantage of rising interest rates. So if you're nervous about your fixed income exposure and what will happen as rates rise, you might want to think about moving some into hedged equity. So you're not taking too much undue risk doing that, and you may actually benefit from rising rates.
All right, well, thanks a lot, Brad.
Thank you.
Thank you for watching The Street.